Last week, after my video on downsizing traps, I got a comment from a bloke named Gary in Ballarat. Gary said, and I'm reading this word for word, mate, we finally burned our mortgage statement last Saturday. 31 years. Kids came over. Wife cried. I feel like we've actually won. Gary, I need you to come back to this video right now because you did not win. Not yet. And I am not saying that to crush the joy of that moment. That moment is real. That celebration is earned. But what nobody told you at that kitchen table, what your bank definitely did not tell you, what your super fund manager never mentions, and what most accountants only realize when it's already too late, is that the moment you paid off that house, you locked somewhere between $400,000 and $900,000 of dead equity inside four walls that the ATO is waiting patiently to tax, that the probate system will charge your kids tens of thousands to unlock, and that one specific life event, losing your spouse, can trigger a tax bill that wipes out a decade of retirement savings overnight. I've spent 15 years analysing Australian estate and tax structures. I've sat across the table from retirees who did everything right, worked hard, paid off the home, retired with dignity, and watched them lose $80,000, $120,000, sometimes more, because nobody gave them this information while they still had time to act. That ends today. Before I go any further, if you're watching this and you own your home free and clear, or you're within 5 years of paying it off, smash the like button right now. I'm not asking for vanity. In 2026, YouTube's algorithm actively suppresses financial content that teaches everyday Australians how to legally protect their retirement wealth. Every like pushes this past the filter and into the feed of one more retiree who is about to make a $100,000 mistake they cannot undo. Hit it now, then keep watching. Let me tell you about Barry and Colleen Mitchell. Barry and Colleen bought a 3-bedroom brick veneer in the outer eastern suburbs of Melbourne in 1994. They paid $185,000. Barry was a fitter and turner at a manufacturing company in Bayswater. Colleen ran the admin at a primary school in Ringwood. They raised 3 kids in that house. New kitchen in 2006, carport in 2011, solar panels and a new hot water system in 2019. And then, after 30 years of grinding that mortgage down, in 2024, Barry burned the statement. The kids threw a Barbie. The neighbours came over. His mate from work brought a slab of crown. The CoreLogic estimate on that house, already north of $950,000. By early 2026, after another run in Melbourne's Eastern Corridor, the property was independently valued at $1,100,000. Barry and Colleen Mitchell have $915,000 of unrealised profit sitting inside that house. They think they're set. They think the house is their greatest achievement, their retirement plan. And they're right, until the tax code turns it into a landmine. Here's what the lawyers want me to say. I am not your accountant. I am not your financial advisor. I am not your solicitor. This is general financial education, not personal advice tailored to your situation. Australian tax law is state and federal. What applies in Victoria may differ from what applies in Queensland or Western Australia. Get advice from a registered tax agent, a board-certified estate planning solicitor, or a financial planner who actually understands CGT Event A1, the Main Residence Exemption, and the difference between a testamentary trust and a piece of paper with your wishes written on it. What I'm giving you today is a survival map. Use it to ask better questions. Now let's get into it. This is not one problem. It's 3 problems stacked on top of each other, and each one makes the next one worse. Most Australians believe the family home is completely tax-free when you sell it, and for most of your life, that's true. Under Section 118-110 of the Income Tax Assessment Act 1997, your main residence is fully exempt from capital gains tax if you've lived in it as your main home for the entire period you've owned it, you haven't used it to produce income like renting part of it out, and it's on land of 2 hectares or less. So for Barry and Colleen, selling while both are alive, having lived in the home since 1994, the full main residence exemption applies. They sell for $1.1 million. Their capital gain is approximately $915,000. Their CGT, zero. Every cent is exempt. That is the system working perfectly. But here's what almost nobody tells you. The exemption doesn't automatically travel with the surviving spouse. When one of them dies, the rules around what happens to the home, who owns it, how the cost base is calculated, and what exemption applies, change dramatically. And if you don't act inside a specific window, you can lose tens of thousands of dollars in exemption that you can never recover. Under Australian tax law, death is not a CGT event for the primary residence. The asset passes to the surviving spouse, and the ATO does not trigger a capital gain at that moment. But here's the critical detail that costs Australian families money every single year. When Colleen passes away, let's say in 2027, the home passes to Barry under the terms of their will or via survivorship, depending on how the title is held. Barry is now the sole owner. Barry wants to sell. He's 73. The house is too big. He wants to move to a smaller place on the Mornington Peninsula to be closer to his daughter. If Barry sells within 2 years of Colleen's death, the full main residence exemption still applies. Under Section 118-195 of the ITAA 1997, a surviving spouse who inherits a main residence and sells within 2 years of the date of death can access the full CGT exemption, even if they don't personally satisfy the residency test for the entire ownership period. He sells for $1.15 million. Capital gain, potentially zero. Tax, zero. That's the escape hatch, the 2-year window. Now watch what happens when Barry misses it. Barry is grieving. He can't make decisions. His kids say, "Dad, don't rush. You don't have to sell yet." His accountant doesn't mention the 2-year rule because they mostly do small business BAS returns and don't specialize in estate CGT. 3 years pass. Barry sells in 2030 for $1.2 million. Now we need to work out his cost base. The rules here are more complex than most people realize. Under Section 128-15, for a post-CGT asset like the Mitchells' home purchased in 1994, Barry's inherited cost base is the market value of Colleen's share at her date of death in 2027, approximately $575,000, which is half of the $1.15 million value, plus Barry's own original cost base for his share, $92,500, that's half of the $185,000 purchase price, plus half of documented capital improvements. Total adjusted cost base, approximately $667,500. Barry sells in 2030 for $1.2 million. Capital gain, approximately $532,500. The main residence exemption may apply, but only for the proportion of time the property was used as a main residence relative to total ownership. In the worst-case scenario, partial exemption, single filer, combined income from super drawdowns and age pension supplements, Barry could face a CGT bill of $40,000 to $65,000 he never anticipated, because nobody told him about the 2-year window, because the system relies on your ignorance. Right now, stop scrolling and drop a comment. Tell me, do you own your home free and clear? What year did you buy it? And have you ever actually calculated the capital gain sitting inside those walls? I am not asking out of curiosity. I'm asking because I can almost guarantee you've never run these numbers. And when you do, what you find is going to shock you. Drop your suburban year of purchase in the comments. Let's do this math together publicly. So the next family watching this video has real numbers to compare against. Now let's go to layer 2. This is where the dead equity trap becomes genuinely cruel, because it doesn't just hit the house, it hits every dollar of retirement income the surviving spouse is trying to live on. Here's what most Australian retirees don't realise about super. When your spouse dies and leaves their superannuation to you, the taxation of that inherited super depends entirely on how it's structured and your relationship. If Barry and Colleen have their super structured through accumulation phase and the balance transfers to Barry as a death benefit income stream, part of that may be taxable depending on the taxable versus tax-free components. But here's the income stacking problem. In the year Barry sells the house, let's say 2030, his assessable income looks like this. Age pension, approximately $29,000. Super drawdown from his account-based pension, $28,000. Taxable portion of inherited super income stream, $14,000, plus capital gain from the home sale, up to $532,000, partially reduced by the main residence exemption. Even if most of the capital gain is exempt, any portion that isn't exempt gets stacked on top of Barry's ordinary income. And in Australia, unlike the US, capital gains don't sit in a separate lower tax bucket. Net capital gains are added directly to your assessable income and taxed at your marginal rate, subject to the 50% CGT discount if the asset was held for more than 12 months. So if $100,000 of Barry's capital gain is assessable after the exemption and the 50% discount, that $100,000 gets added to his $71,000 of other income. His total assessable income hits $171,000. His marginal tax rate on that top slice, 45 cents in the dollar, he pays $45,000 in income tax on a capital gain from the family home he paid off 30 years ago. That is the income stacking trap, and it is completely preventable with the right structure. Now, I'm going to give you the legal framework that estate planning solicitors charge $4,000 to $8,000 to explain. The most powerful structure available to Australian couples with a paid-off home and substantial superannuation is the Testamentary Discretionary Trust. A testamentary trust is created by a will. It comes into effect when the first spouse dies. The assets, including the family home, any investment properties and cash, flow into the trust rather than directly to beneficiaries. The trustee, typically the surviving spouse or an independent trustee, then has discretion over how income and capital gains are distributed among the beneficiaries, which can include the surviving spouse, adult children, and even grandchildren. Why does this matter for tax? Because distributions from a testamentary trust to minor beneficiaries, including grandchildren, are taxed at adult tax rates, not the punitive minor income tax rates that apply to other income. And because the trustee can choose which year to distribute, how much to distribute, and to whom, optimizing across multiple tax brackets simultaneously instead of dumping everything into the surviving spouse's single high-income year. Let me show you the difference with Barry. Without a testamentary trust, Barry inherits everything directly. In 2030, he sells the house, realizes a capital gain, stacks it on top of his pension and super income, and pays tax at the highest marginal rate on the excess. Total tax, $45,000 to $65,000. With a testamentary trust, the assets flow into a testamentary trust on Colleen's death. When Barry eventually sells the house, the net capital gain is distributed across Barry, his son in Victoria, his daughter in Queensland, and potentially 2 adult grandchildren who are in lower tax brackets. The same $100,000 of assessable capital gain, split 5 ways at lower marginal rates, might generate a combined tax bill of $12,000 to $18,000. Same house, same family, same decades of sacrifice. The difference is the structure. I also want to show you how geography changes outcomes, even within Australia. In Victoria, there's no state land tax on the primary residence while you live in it. But if the home passes into a trust after death, land tax treatment changes. Discretionary trusts do not receive the principal place of residence land tax exemption in Victoria. You need specialist advice on how to structure the trust to minimise ongoing land tax exposure. In Queensland, there's no land tax on the family home and more flexible trust structures for land tax purposes. Some structures that create ongoing costs in Victoria are cleaner in Queensland. The point is not that you should move states to save tax, though some families do consider this. The point is that the rules are different everywhere, and what's optimal in one state is expensive in another. If you own property across multiple states, an investment property in Queensland and the family home in Victoria, for example, You need an advisor who understands multi-jurisdictional land tax aggregation, because the ATO and state revenue offices are all watching. Now let me stop diagnosing and start giving you the operating instructions. 6 steps. Write these down. Step 1. Calculate your actual cost base today. Pull your original purchase contract. Add every capital improvement you've made since purchase. New kitchen, new roof, bathroom renovation, extension, solar panels, fencing. Every dollar of documented capital improvement increases your cost base and reduces your future CGT liability. If Barry and Colleen can document $75,000 in capital improvements since 1994, their cost base increases from $185,000 to $260,000, saving them $18,750 in CGT at a 25% effective rate. Keep records forever. This is your first line of defense. Step 2. Check how your property is titled. Go to your state's land registry and confirm how the property is held. Joint tenants, tenants in common, in a company or trust name. The titling determines what happens to the asset on death and whether you can access the Main Residence Exemption as a surviving spouse. Joint tenancy means the property passes automatically to the surviving spouse by survivorship. This is the most common arrangement and works well for the 2-year exemption window. If your tenants in common with unequal shares, you need specialist advice. The tax outcomes are different. Step 3. Know your 2-year window before you need it. Every Australian couple who owns a home jointly needs to understand Section 118 to 195. If your spouse dies, you have 2 years to sell and access the full Main Residence Exemption. If you miss that window, you face a partial CGT liability based on the period the property was not a main residence of a person who could access the exemption. This is not a rule you want to discover for the first time while you're grieving. Put a reminder in your phone, write it in your will file. Tell your kids the 2-year clock starts the day your spouse passes. Step 4. Get a testamentary trust built into your will. Now, while both spouses are alive, a testamentary trust must be established in the will before death. You cannot retrofit it after someone has already passed. The planning window is now, not after the diagnosis, not after the funeral. Now. The average cost of having an estate planning solicitor draft a will with testamentary trust provisions, $2,000 to $5,000. The tax saving over a single capital gains event, $30,000 to $80,000. That is not a close call. Step 5. Review your super death benefit nominations. This is the one Australians consistently get wrong. If your superannuation is left to a non-dependent, adult children for example, the taxable component of that super is taxed at 15% plus Medicare levy on the way out. On a $400,000 super balance with a 70% taxable component, that's $46,200 in tax that goes to the ATO instead of your children. A binding death benefit nomination directing super to a spouse or dependent avoids this tax entirely. Review your nominations today. Step 6. Coordinate your home sale with your super and income strategy. If you're planning to sell the family home in the same year, you take a large lump sum from super, or in the same year, you wind up an investment property, your assessable income in that year may be significantly elevated. A qualified financial planner and tax agent working together can help you sequence these events, potentially spreading income across 2 tax years, timing super drawdowns, or using strategies like charitable contributions to reduce taxable income in high CGT years. Timing is everything, and timing requires planning while you still have options. Save this video right now, favorite it, bookmark it. Put it in your private library, because 6 months from now, when you're sitting across from an estate planning solicitor, you are going to want to pull this up and review the exact math, the exact code sections, and the exact strategy before that meeting. Save it. Let me give you the final comparison so you can see the full picture. Meet Judith and Peter Thornton, Melbourne, Victoria. They bought in 1996 for $210,000. Current value, $1.3 million. In 2022, their estate planning solicitor set up wills with testamentary trust provisions. They know the 2-year rule. Their supernominations are correct and reviewed annually. Peter passes in 2028. Judith sells the family home 14 months later, inside the 2-year window. CGT 0, full main residence exemption applies, probate on a properly structured estate with a testamentary trust, minimal, managed, controlled. Judith keeps the full $1.3 million, distributes assets through the testamentary trust, pays tax on income at blended family rates. Total cost of planning, $4,500 in legal fees. Total tax on home sale, 0. Now meet Jeff and Margaret Parsons, also Melbourne, Victoria. Bought in 1995 for $195,000. Similar appreciation. No testamentary trust. No estate planning review since 1998. Supernominations unchanged since 2009. Margaret passes in 2027. Jeff is devastated. Kids say, "Dad, don't rush." Nobody mentions the 2-year window. Jeff sells in 2030, missing the deadline. Partial main residence exemption applies. Assessable capital gain after the 50% CGT discount and partial exemption, $180,000, stacked on top of super drawdown and pension income. Marginal rate on excess, 37%. Tax on home sale, $66,600. Super death benefit passes to adult children. Taxable component heavily taxed at 15% plus Medicare. Probate on an unstructured estate with a simple will, $25,000 to $40,000 in legal and executor fees. Total cost of not planning, $100,000 to $120,000. Same suburb, same love story, same 30 years of sacrifice, different solicitor, different outcome. That is the difference between knowing and not knowing. That is the difference between having an advisor who understands what's actually at stake and one who just files your tax return. You now have the information to beat the dead equity trap. But I have seen this 1,000 times. People watch the video, they nod along, they say they'll handle it next month, and then next month becomes next year. And next year becomes the phone call from the hospital, and by then it is too late. Knowledge without action is just expensive procrastination. Go to your website link right now and get the 2026 Australian Retiree Asset Protection Checklist. It will walk you through exactly how to calculate your CGT exposure, review your title, check your supernominations, and find the right estate planning solicitor for your state. It is free, it is specific to Australian law, and it takes 10 minutes. If you're still watching, you're part of a very small percentage of this audience that actually stays to the end. That tells me you're serious. That tells me you understand that the paid-off house is not the finish line. The house is the starting line. The structure around the house is what protects your family. Here is my final assignment for you. Pull your deed this week. Look at how the property is titled. Is it in joint tenancy? Is it in tenants in common? Is it in just one spouse's name? Is it in a trust? If you do not know the answer to that question, you have work to do. And the longer you wait, the more expensive that work becomes. I'm the retirement insurgent. I don't work for the banks. I don't work for the ATO. I work for you. See you in the next one.